Good afternoon. This is Sam McGrasty with Brady Ware Dealership Advisors, and excited about this month's webinar. This month's webinar is going to be on dealing with making your dealership more valuable. We hear from a lot of the business brokers and capital markets people this year that the M&A activity and the transaction activity in the dealership space is hotter than ever, and we get a lot of questions, a lot from our dealers asking what can they do. They know they might want to do a transaction a year away, 3 years away, sometimes even 5 years away. What are things we can do regarding value of their dealership? So this month we're happy to have our own resident expert, Mike Stover, who does a lot in the dealership valuation space in our group, kind of present this month on things you can make your dealership more valuable. So with that, I'll turn it over to Mike.
Thank you, Sam. My name is Mike Stover. I'm a partner with Brady Ware. Been here for 31 years and involved in valuations of dealerships and other businesses since most of that time. I have an accreditation in business valuation that I've had for the past 20 years. And we've been doing valuations for not only M&A transactions, but also gift and estate tax compliance, litigation support, domestic relations, anytime that you need to determine what the value of the business is or an interest in the business, we get involved. So to get things started, when we talk about evaluation, we first need to understand some ground rules, some definitions. First among those is that we need to understand what the different standards of value are. Fair market value is a term that we hear pretty often, but it's actually something that started with the IRS. It's the standard of value that is used for tax purposes or with the Bureau of Labor in ESOP valuations. Fair market value is defined as the price that's negotiated between a hypothetical and willing seller and a hypothetical and willing buyer, neither being under the compulsion to sell or buy, and both having reasonable knowledge of all the facts. Now, that standard, that definition is used in a lot of places, but it's important to understand where it came from and what it means. Another standard of value is fair value. Oftentimes you hear that for litigation purposes or financial reporting. It's different than fair market value. And lastly, we could have strategic value. And that again is another standard of value that really relates to the value for a specific investor or buyer. Now, besides the standards of value, we also need to understand what the premise of value is. When we're valuing a business, we could do so as if it were a going concern. Usually we are. This business is going to continue and the operations are going to be pretty much the same for the buyer as they were for the seller. But we could also have a different premise of value. We could have an assemblage of assets. In other words, we're valuing just the underlying assets that the company owns, those typically being the tangible assets, inventory, fixed assets, and so forth, and would not include the intangible assets, such as the reputation of the company, the workforce of employees that it has, and other type of intangible assets. Another premise of value could be a forced liquidation, and you can imagine what that entails. It doesn't sound good, and it's not. Typically, that's a fire sale. And if our premise of value is a forced liquidation, the value is going to be quite low. Also, if we're valuing an interest in a company as opposed to the entire company, we need to understand that a 20% interest in a company, for instance, is not worth 20% of the total because you don't have control, and typically you don't have a market. Having control is so important because it allows you to make all the decisions. For now, let's assume that we're talking about the value of a company, a dealership as a whole. Now, whether we're talking about the valuation of dealerships or tool and die companies, barber shops or restaurants, the key concept in valuation.
Hey, Mike, just a real quick question is, it sounds like depending on what you're going to use the valuation for, you may be using a different standard, one of these different standards of value that you describe. Is that correct?
Yes, each valuation engagement hinges on these different understandings, the standard of value, the premise, and the interest.
So if somebody's using it to see what their company is to go to market versus doing a gifting and estate thing, the methodology could be different, correct?
Yes, it could, and we'll touch on that in a little bit.
Okay, good.
Now, whether we're talking about dealerships or tool and die companies, barber shops or restaurants, any kind of company, the key concept in valuation can really be boiled down to one simple equation: earnings times a multiple. This seems pretty simple, but it's really the basis behind all of the different valuation approaches and methods that you commonly hear. The income approach is something that all valuation experts use. There are a couple of methods under that: a capitalization of historical cash flows or discounted future cash flows. They all have earnings as the basis for their calculation, and the capitalization rate or the discount rate can be thought of as a multiple. When looking at a market approach, which is an approach that is based in comparison, that too is based really on earnings and a multiple. If you're looking at publicly traded companies, the most often multiple that you hear is the PE ratio, right? Price divided by earnings. That's another way of turning around this equation of earnings times a multiple. If we're looking at private companies that have sold, those prices can be developed into multiples by dividing by earnings, whether it's revenue, net income, cash flow, seller's discretionary earnings, what have you. It all boils down to earnings times a multiple. Now, earnings is probably the easiest factor for you to influence. Establishing a track record of profits that show consistent growth from year to year signals stability for a potential buyer. Earnings are also influenced by hiring and retaining a great team that delivers results. Employee turnover is a costly expense that is not easily seen on a financial statement. On top of that, you want to make sure that your dealership is looking the part. When you keep up your image and keep your facilities in good condition, it's money that a buyer won't have to spend to change later. You also need to keep innovating. Don't be left behind. Investments in digital marketing and the new tools that are needed to reach today's consumer will pay dividends down the road. One of the most important elements of maintaining healthy earnings is a solid fixed absorption ratio. Your goal should be 85%, but the closer you can get to 100%, the more value you'll drive into the business. You always need to keep in mind that buyers aren't willing to pay for the work that they will have to do to improve your dealership. Inventory turnover is also immensely important. One thing that we see in the most profitable dealerships is that inventory turnover is usually quite high. Often floor plan assistance from the manufacturers is more than the actual floor plan interest paid. Taxes are also an element of earnings, and the experts at Brady Ware have strategies that can help you earn more and keep more of what you earn. And it's those earnings or the cash flow that is going to help influence the value of the dealership. Now we've talked a lot about earnings, but the earnings of what? A buyer gets the future earnings of the dealership, not the historical earnings. But we typically look at the past in order to form an opinion about what the future is going to look like. For a financial buyer, that may be a good approach. You may not have a crystal ball of what else you could expect other than looking at history. And as we discussed before, for a financial buyer, fair market value is often the standard that would apply. It's the value that any willing buyer would assign to this business. But a synergistic buyer is quite different. And that, Sam, is, I think, the point that you were trying to make. A synergistic buyer is capable of taking the cash flow from your dealership and make changes in order to improve it. In an M&A type situation, if we're selling a dealership, the highest price is going to be found with a synergistic buyer. They usually can spread the fixed costs over a larger pool of sales. They can leverage the talents of key individuals on their management team and apply them to your dealership. They can combine other operations like service or body shop to improve profitability of not only the subject dealership, but the dealerships that they already own. The synergy of 1 + 1 = 3 means that a synergistic buyer sees future cash flow being quite different than historical cash flow. Now, while a synergistic buyer won't pay you for all of the value that he or she is going to create, they usually will pay some higher price in order to get the opportunity. That's why you see synergistic deal prices higher than financial deal prices. Is that what you had in mind, Sam?
Yeah, I think you always hear about that strategic premium. No, exactly. I think sometimes with that strategic premium, you see a dealer that wants a specific brand or a location, or you see that premium being paid, and that's what I was kind of alluding to earlier, Mike.
Absolutely. Earnings are so important, and it's the future earnings that really matter. Now, it's hard to predict what those future earnings are going to be, but to the extent that a buyer has control over those earnings or can do things to help generate better earnings, that will eventually translate into some increased value for the dealership in question.
Hey, Mike, what do you see in your valuations of multiple dealers that have multiple brands? I always hear the Highline brands carry a certain multiple over the domestics. How do you take that into account when you're doing some of your evaluation work, Mike?
Well, that fits right into what we're going to talk about now is the multiple. The multiples for those dealerships are generally higher, primarily due to the forces of supply and demand, right? The Highline dealerships, there's less supply, and the lesser supply of those dealerships translates into the lesser perceived risk, right? If there's only one Lexus dealership in town, all the customers, if you want to buy a Lexus, you're going to go to that one Lexus dealership that's in town. If there are 20 Ford dealerships in town, then you have your choice as a buyer. So that factor that you're describing, Sam, really fits into the second part of the equation, that being multiple. And the way to think about the multiple is that it's really the buyer's perception of the perceived risk. The higher the risk, the lower the multiple, and vice versa. The lower the risk, the higher the multiple. So in our valuation equation, if we can increase earnings, we increase value. If we can increase the multiple, again, we increase value. If we can do both, now we're really increasing the value. And talking about the valuation multiple, it's maybe helpful to think about what kind of things impact that multiple. If your dealership is underperforming, it's a risk for anyone to buy it. That decreases the multiple. Higher volume stores usually command a higher multiple. And the same is true if you've got multiple locations, because some costs, and hence the risk, are reduced. Again, underperforming stores are maybe an opportunity for a future buyer, but again, that future buyer is not going to pay you for the value that they're going to create. They may pay some for an opportunity, but that's not the same as if the performance were already there. Other demands for buyers could increase the multiple, such as the location, right? Good or bad, that impacts the multiple, as well as the make of the car that you're selling, just what you alluded to, Sam. Competition or low customer satisfaction rating, low retention rates, they all increase the risk and therefore lower the valuation multiple of the dealership. The management team can also impact risk, namely the dealer himself. For example, if I own Mike Stover Ford and I want to sell my dealership, what one thing is going to be immediately different about the dealership on the day after the sale? Well, that's right, it's me. I'm not going to be there. As the owner, I won't be there after the sale. If the owner has not built a good management team, one that can run the operation when he's not there, if the owner is so tied to the business that its success depends on him, then there's a lot of risk to the buyer. Again, more risk, the lower the multiple, the lower the multiple, the lower the value. Interest rates can also affect the multiple. The lower the cost of financing, the more debt that a given stream of cash flow can support. Of course, lower interest rates also improve the first variable in our equation, that being the earnings. So lower interest rates, such as we've seen lately, really help to improve the value of the dealership from both perspectives.
Hey, Mike, also during the valuation process, I know there's a lot of normal, especially on dealerships, there seems to be a lot of what I call normalization adjustments to get the earnings to reflect what's actual sometimes. You know, normalizing the rent factors or some other things. What are some of the things you see like that drive that obviously drive the earnings and have an effect on the multiple?
Well, you're right, Sam. What you're describing is the buyer's cash flow. What can they expect when they acquire a dealership, right? They don't get the historical cash flow, they get the future cash flow. And in order to try to figure out what that future cash flow looks like, oftentimes there need to be some normalizing adjustments made to the financial statements. For instance, the dealer may pay himself a higher or lower salary than what a buyer may consider appropriate. Oftentimes that is depending on the structure of the dealership for tax purposes, whether it's a C corporation or an S corporation. The amount of officers' compensation can vary quite a bit from dealership to dealership. Rent is another one of those areas. If the company is a C corporation and we're trying to get earnings out of the corporation to avoid the effect of double taxation, increased rent payments can do the trick. So a buyer, if these maybe also acquiring the real estate, will want to add back those rent payments to normalize the income, to see what they could expect going forward. There could be other kinds of adjustments that a buyer could expect to make, such as valuing inventory on the FIFO basis instead of LIFO. There may be other expenses that won't occur under the new ownership. Maybe a family member is on the payroll, or maybe we've got non-operating assets on the company's books, such as a condo in Florida. Those kinds of things would be removed from the financial statements in order to get a good idea of what the buyer would expect the future cash flow to be.
Hey, Mike, how would you address, facility upgrades that are coming around the corner? They haven't hit the financial statements yet, but you're a General Motors dealer and you've got a nice upgrade package waiting for you in a couple of years. How would you take that into account in valuing your dealership?
Yeah, absolutely, because that really speaks to the issue of future earnings, right? If a dealership has not gone through that facility upgrade, the remodeling, the new re-imaging, the future cash flows are going to be impacted. That new buyer of the dealership is going to have to spend that money. If you compare that to a dealership where those improvements have already been made, then it's a lot easier to see how future earnings are going to be better. So absolutely, that affects the first part of our equation, and correspondingly, it increases the value.
Thanks, Mike. Another question I hear a lot from dealers is, when dealerships seem to sell, they sell at an earning a blue sky multiple plus fixed assets, plus the inventory is usually a flip. The new inventory is usually a flip, and then the other pieces are sold separately with used vehicles or used equipment, depending on what kind of dealership you are. How do you translate that into, like, when you do a discounted cash flow method or something like that?
It's really two ways of saying the same thing. The common method of using a blue sky multiple is the exact equation that we've been talking about, right? Earnings times a multiple. Well, in this case, instead of the result being the value of the company as a whole, the result is the value of the goodwill that's assigned to the purchase. Dealerships are often traded this way. The value of the intangible asset, the goodwill, or in this case, the blue sky, is the result of applying this valuation formula. And then the value of the fixed assets is added to that later. It's the same equation. It's being used a little bit differently in the valuation of a dealership. Oftentimes, they're valuing just the blue sky, but the concept is the same.
All right, thanks, Mike. That's a question I often get when they look at evaluation, is that, when they go to sell, you see letters of intent being traded back and forth, that they always go back to, a multiple. You hear a multiple of blue sky a lot of times, and it plus fixed assets. So it's which is a little bit different in this industry versus some other ones, I would say.
It is, and one thing to keep in mind is that that blue sky multiple is often applied to the income before tax. So it's important that in trying to increase the value of a dealership, that you take care of earnings. If you're planning for a sale in the near future, you want to think 3 to 4 or 5 years into the future and and take the steps necessary to show that you've got good earnings and good cash flow.
Yeah, so sometimes it's if you think you're coming, you maybe want to do a transaction, 3 years, 5 years out. It may be time to start cleaning up the financials a little bit and that sort of thing.
Absolutely. If you've got non-operating assets on the books, it might be a good time to get them off. If you've got family members on the payroll, it might be a good time to get them off the payroll. Buyers typically look at these normalizing adjustments that we've been talking about with a little bit of skepticism, right? They might think that that some of that adjustment will actually end up on the bottom line, but they might not give you 100% credit for all of them.
That's
so
correct.
The best solution is to get rid of it before you have to explain it to a potential buyer.
I totally agree with that. I see that a lot where they do not want, they, especially on the bonus rents or non-operating employees, that's always a discussion point in transactions, it seems like. So,
and you've helped a lot of dealers with that process, Sam.
Yeah, absolutely. Absolutely. Seems like we're in that discussion quite a bit. The other thing I would ask you, I hear, sometimes when we were going through the evaluation process, these projections are thrown together fairly quickly. And I would always, I mean, I've always talked about two dealerships, making the same amount of earnings, but one's growing at 2%, one's growing at 8%. It gets factored in. So there's really an importance on these projections when you put these projections together when you're going through this process. Wouldn't you agree?
Oh, absolutely. Growth is a very important factor. If you think back to our formula, the earnings, and the discussion that we had that a buyer is looking at future earnings, future earnings are impacted by growth. And a dealership that has the opportunity for future growth is going to receive a lot higher value than one that is stymied and has no growth possibilities. So it's the reason that so many high-tech publicly traded companies trade for just an obscene multiple, is because the earnings are growing so fast.
No, I think that's just really critical to really take that stuff seriously when you're kind of putting projections together and when you get your dealership get an evaluation done. I think just to close out, I think you've got some really good points, Mike, where human capital is important, earnings is obviously the most important, but also having retaining a management team and having human capital inside, especially in today's job market, is important. I think factoring in what brands you're selling and the future growth and all those are good factors to kind of keep in mind when you're doing evaluation that's just more in depth. I mean, so many times I think we all get phone calls like, hey, what's the multiple for my Ford store or General Motors store or Lexus store? But there's a lot more that goes into that once you get involved in a transaction.
Absolutely. It really comes down to earnings and the risk.
No, I really appreciate it, Mike. Thanks for time today, kind of going over some of this. I think, like I said, we've seen, I think we've all read and seen, and there's a lot of transaction activity going on right now in the dealership space. So I think this is really good information. And I think if you're thinking about a transaction or down in the future, it's important to maybe get some counseling now and do some things ahead of time. It's always a lot easier when you do it beforehand versus at the end. But with that, I'd like to wrap up the webinar for this month. Next month, we will not have a webinar. We will cordially invite you to our annual dealership conference on September 19th at the Hollywood Casino in Columbus, Ohio. We've got Cliff Banks, who's a real thought leader in the dealership space, going to really give us an update on some of the evolution of dealerships. And also, we're going to have Kevin Timmerson from Blavia Blatt join us as well to give us some ideas on he's involved in a lot of transaction activity and also dealing with the manufacturers. So we're looking forward to hearing from those folks what they've been seeing out there. And we always have a good event. So I invite everyone to join us there, and hopefully I see you on September 19th. Thank you.